What's up everybody, Gareth here. Today I'm going to tell you all I know about fundraising for your business. Watching this video will equip you with some of the top tips that I've learned from fundraising over the past 10 years growing numerous multi-million-dollar businesses. A quick side note before getting into this, I would first recommend that every entrepreneur tries to remain as lean as possible at the very beginning so that they don't require fundraising until it's absolutely crucial. Doing this means that you give away less of your company. The further advanced you are as an entrepreneur on the startup journey, the less equity you have to give away because your company is more assured. There's less risk for an investor. The longer you can do this, the better, and I'd really recommend it. Starting out, most entrepreneurs don't have any idea what they're doing. Every single day is a learning curve, and it's really exciting. However, this is a very steep learning curve because that's when you're making the most mistakes. Therefore, that's when you have the most risk. The risk is so high that I would recommend that you look towards your inner network of connections, your family, your closest friends, and other people maybe that you work with who will listen to your crazy idea at the beginning. They're taking a punt based on what they know of you more so than what they know of the business. This type of investments carries a little bit of added pressure because these are relationships that you hold dear to you. Number 2, accelerators. These are organizations that actually specialize on growing businesses from an early stage upwards. Accelerators generally have an interview process where they'll actually bring you in and interview you on your business plan and your product. If you're selected from the application process, they bring you into the cohort of new startups, and generally they'll try and teach you and grow you together. These organizations have mentors that will be assigned to you to help you grow your business. In exchange for this learning, they'll charge you a fee and sometimes even some equity. The hardest part about accelerators is choosing the right one. You don't want to join an accelerator if it's not the right fit. You should look for accelerators that have had successful candidates and companies before you that are in your space or in your industry. They usually last between 1 to 3 months. However, I have seen some that go 12 months and beyond. Accelerators are a great idea, especially for first-time entrepreneurs. The third option, equity fundraising. This is one of the most common ways to fundraise for most companies around the world. Essentially, you're giving shares to an investor in exchange for their money. This investment is then going towards growth capital in your business to expand your marketing, your sales, your hiring plan. There are different stages with which different investors normally invest. Seed stage, which is generally $0 to $1 million in investment. Then you have a Series A, which is generally $2 to $10 million investment. Then you have Series B, Series C, Series D, and so on, and it just keeps getting bigger and bigger. With equity fundraising, the most important thing here is that you're giving away your equity as a founder in exchange for capital. You want to make sure that this investor sees the future the way you see it, that isn't in a hurry to sell way before you want to sell. Maybe you don't want to sell at all. So it's so important that you get this relationship right. You have to be so careful with investors that you don't bring in the wrong investors who try to control you and your business and the direction you go in. When you're picking investors, I would ask for references from other people they've invested in to see what type of investor they are. This is you digging down to get to know who you're bringing on board, that they align with your vision. The fourth way of fundraising, there's a huge amount of subsidies, support, and investment options for companies and startups provided by their local governments and councils. In your research phase for your new business, what you really should be doing is checking out these local supports. In a lot of cases, these local supports and government subsidies can be given at a very beneficial rate than where you would get anywhere else. These government subsidies and supports require a huge amount of paperwork and they are very time consuming. However, they may be a better port of call than through equity fundraising where you actually give away more equity for the same amount of money. You can actually use the fact that you're getting government support to raise further equity fundraising. So you can say to an investor, look, if you put in 100,000 now, I'm also doubling that up with the government support and subsidy. This is then safeguarding that investor's initial investment. The fifth option is crowdfunding. Crowdfunding became really popular over the last few years because it's allowed the everyday person to invest in companies that they get excited about. There are some really well-known websites like Kickstarter and others like Crowdcube in the UK. They essentially allow you to put your business on their platform, and they'll raise micro investments from $100 all the way up to $100,000 and above for your company. There's some great success stories here and some companies that have done really extremely well. One thing to note around crowdfunding is that you need to have a really catchy video. Getting this video right requires a lot of time, investment, and editing skills to make that video really catchy. You have to get your point out there very quickly and snappy as to why they should invest with you, your company, your vision, and what you plan to achieve. The last form of financing is bank loans. Now, banks generally aren't that good at giving startups loans, especially in the early days. But as you scale, a bank loan may be one of the best ways and cheapest ways to finance your business. Banks take no equity, which is a huge positive. With a bank loan, you can also potentially lock down a lower interest rate. Generally, however, bank loans are for later stage fundraising for businesses, as the appetite for risk in banks is a lot lower. And in some cases, they require personal guarantees, which I would be completely against as an entrepreneur. Remember, starting off, you're putting everything on the line. You're putting your sweat equity in. You're putting your time, in a lot of cases, your money. You got to be really careful putting down personal guarantees because at the end of the day, there's a high probability of failure. You don't want to be left with nothing. With each of these funding routes, you're going to have to present your ROI, your return on investment. So it's important to keep that clear in your head. Whether it's the moonshot to an IPO, initial public offering, or it's the 4 or 5 year turnaround where you sell your business, or this is an extremely profitable, lucrative company that you're going to keep private and turn into a generational business. And that's it, everybody. Please like and subscribe if you got some value out of it. I look forward to seeing you on the next one. Every second counts.